Advanced Financial Accounting Excel Practice Problem. In this presentation, we're going to work a practice problem in Excel related to a consolidation where we have a parent-subsidiary relationship, the parent owning a controlling interest over 50%, but not 100%. Therefore, we will have a non-controlling interest we want to deal with. We'll be focusing in on a sale, a bond sale or issuance, this time from S to P rather than from P to S. It was issued at a premium, so we'll have to deal with that elimination or adjusting transaction or consolidation transaction within our consolidation. Get ready to account with Advanced Financial Accounting. Here we are in Excel. We have our information to the left. We're going to be entering that information in the blue area on the right, including worksheets, journal entries, and our consolidation worksheet on the right showing the trial balance for P and S as of the date of consolidation. Let's go back on over to the left and see what we have. We've got P purchased a percentage of S. P is the parent, S the subsidiary. Common stock on January 1st, 2000 X1. That purchase percent was 90%. So 90% has been purchased. We're not going to be dealing with the cost. We're going to have a fairly simple transaction, so we won't need to be reconstructing the goodwill here. The non-controlling interest fair value or the non-controlling interest is going to be 10%. The purchase was at the same value as the book value. Therefore, we're not going to have to deal with any differential within this problem because our focus is going to be on this item with the bond sale. So on January 1st, 2000 X1, S sold bonds to P. So now we're going from S to P on the sale of the bonds. Par value is going to be that 97,000. The percent on the bond, 6% years, 5 years. And then cash received was the 101, therefore we sold it at a premium, or it was sold as a premium, at a premium. So the interest paid annually on December, so we don't have semi-annual payments, we have payments once a year as at the end of the year. So like we want to know which way these bonds are going. So remember, a bond is kind of like issuing a note, but we basically, kind of like loan payment to ourselves, issuing a bond. This time it being issued by S, so S bonds to the parent, so it would be from the subsidiary to the parent, the issuance of bonds and kind of like issuance of debt that we would have. If you would think about the financials then, or if you look at what has been recorded when this took place on January 1st, 2000 X1, we're going to be doing the consolidation as of 2000 X3. We had then the bonds payable is now on the books for S, right? That means S issued the bonds, so they must have received the cash of the 101,000 here and then put on the bonds payable that's going to be owed at the end of the bond. They got the premium because they got more cash than what the bond amount was for, and therefore they have the premium, and they're going to allocate or remove the premium. We're going to do so with a simple straight line method to take the premium off the books. And then on P's side of things, they had the investment in the bonds, which is going to be this item. Let's make that one yellow too. We'll say this item here that we're going to have to deal with regards to an asset for the bonds for the investment in S. So now we of course are going to have to think about, we want to think about how those got on the books basically, or what's the equity method, or what's being accounted for them in the current year. In other words, what's going to be the effect on the income statement, which we can basically see here, but we'll break down those transactions to reconstruct these accounts, and then we'll do our typical reconstruction of the investment accounts up top, at least for the current year. Okay, so to do that, let's hide some cells. I'm going to put my cursor on H and highlight on over to K. H to K, let go, right-click on the selected area and hide them. Then we're going to look at the fully adjusted equity method. So normal equity method, let's think about that first. We're not going to post these, we're reconstructing this account here and this account there. So let's go ahead and do that. Normally, you would say that the investment account in the stock we're looking for, and these two can easily get mixed up to pick up the investment account in the stock and the investment account in the bond. So, be careful on that. So the other side is going to be then to the income from S. And so again, this could be mixed up with interest oftentimes. So be careful there too. So this is going to be for the amount of the 32,180, that's the net income on S's books, times the 90%, the controlling interest percent. Now I'm going to make this a positive by putting a negative in front of it to kind of flip the sign there. The other side is going to be going to the income from S. That's going to be this account down below. So there it is. And you can see we basically reconstructed this number. That's how that number came about. Then we're going to say that we're going to do this thing for the dividends. So we'll say the dividends then, they must have gone up, which would be normally an increase in the cash. And then the other side would be decreasing the investment in S stock. And that would be for our portion of the dividends, which would be the dividends that went out for P was like that 19,000 times the 90% interest times the 90%. There is the debit and the credit there. So we've reconstructed the income side of things, income from S, but not the investment side. If we add up the investment side, that adds up to the 11,862, not matching the investment side over here because, of course, this is a permanent account and is affected by more than just the current year, and these are just the current year transactions. Let's think about what's going to happen in terms of P's books and S's books for the current year. So if we think about this, now we have S selling the bonds to P. So that means that S got the 101,000, and then they put the payable on the books, and P is now holding on to the bonds. So P then you would expect would be the one that's going to receive the cash, the interest payments that happen annually in this case. So you would think what happened on P's book, I usually start with cash here. You would think at the end of the year, once a year at December, they would have gotten cash, you would think. Cash would be going up. And the amount of the cash would be the face amount of the bonds times the 6%. And then the other side of that would be mainly interest income, but we're also going to be decreasing the amount of the investment for basically the amount of like the premium kind of amount, the difference between the fair value and the par value. So we're going to say, all right, so, but the investment in the bonds is going to go down by like the difference between these two, which is going to be what would be the premium on S's side, and then we're going to straight line that over the life of the bond, so it'll basically go down to the amount. You know, we're going to want this amount to go down to or this 107,262. We're going to want that to go down to basically the 101 by the end of the life of this thing, 5 years, because then that's what's going to be owed to us at the maturity date. So then we're going to say, all right, we're going to calculate this as, I'm going to say negative to make it, and then put brackets around it. I'm going to say the 101 minus the 97 would be basically the premium involved, dividing that by the number of years. It's the number of periods, notice, but the periods equals the number of year in this case because they're only getting paid annually instead of something like semi-annual. So that would be $800. And then the interest income then would be the difference. We're going to say interest income would be the difference, which would be the negative sum of these items. So we could see that, and then we can check that and say, is that what actually happened over here? What actually happened, there's the interest income. So that would make sense. We can kind of tie that out to the books. It'd be a little bit more difficult in practice because there's probably be more than just that interest income, but we can figure that out. Then the other side might be the way that most people, when they learn bonds and accounting, you might want to start with the person that issued the bond because that's the side that we typically learn things on the accounting side. So I'm going to start with cash again, even though it's a credit, because that's the thing that makes sense to me to think about first. So I'm going to say, well, the credit then would be the same transaction, basically the same calculation as we did up here. And then we would have the bonds payable going on the books, right? So then you'd have, all right, well then the bonds payable would be going on. I'm sorry, the premium of the bonds needs to be going off the books because we're now paying the cash of 5,820. The premium now needs to go off the books. Same calculation as we did up there for the 800 to reverse the premium. And then we're going to say that the difference now being interest expense rather than interest income. So we're going to say interest expense, and this is going to be the negative sum of these items, which of course is that, you know, the mirror image of that 5,020 up top. And we check the books. Is that what's on the books for S? We can see, yes, indeed, that's what's on the books for S. So then we can think about, okay, what's the difference between these accounts and what are we going to have to think about reversing? So we can see cash nets itself out, so we don't have to deal with that. That's fine. And then on the balance sheet side, we got the investment in S, which was adjusted by that 800. Now note, we're going to have to deal with that, but it's on the balance sheet, so we're going to have to reverse basically everything that's on the balance sheet, right? So we're going to get that from the balance sheet most likely. The interest on the income statement, we need to remove that, and that's usually what we're looking for more here, because like this problem, that's the only interest we see. So it's obvious in the trial balance, but in practice, of course, that wouldn't be the only interest we see here, right? I mean, there might be more interest income involved, and we'd have to figure out, we want to know the amount of interest income. So we just want to note that we're picking out the amount of interest income that it's this intercompany, that's from the intercompany debt, basically the bonds. All right, so then we're going to have this one, the premium. But again, that's a balance sheet account. We're going to remove the entire premium. It's going to have to go off the books. We're concerned, of course, with the interest expense, which we would think would be equal and opposite to the interest income, because once again, you would think there's going to be a lot more than just that as the interest expense, or there might be. And so we want to know these two should be reversing out on the income statement. On the balance sheet, this is affected on the balance sheet, but we're going to basically remove the entire permanent accounts on the balance sheet as well. So we might want to think about breaking them out sometimes if possible. So I'm going to unhide some cells now from F to L, highlighting from F to L, right click, and unhide. Okay, so first I'm going to do the consolidation. We got P's books, we've got S's books. Let's add them together. That's the first step in the consolidation, just adding them together. So we're going to copy that. I'm going to paste it on down. There we have it. Did I do anything funny there? It seemed like something funny happened. No, that looks right. Okay. Then we're going to do our standard adjusting entry. Nothing different, nothing like unusual here, because our focus is on the bonds. But let's just keep practicing the standard elimination entry. I'm going to put this one up top just because it's my habit to do so, but I'm not going to put the number there yet. I'm going to remove the equity for basically S, as our normal process is, which is going to be the common stock, dividends, and retained earnings. So I'm just going to copy that and paste it there. There's the three accounts. Here's the credit that I need to remove for the common stock. It's on the books as a credit. Let's go ahead and debit it to remove it. Here's the retained earnings. It's on the books as a credit. Let's go ahead and debit it to remove it. Here's the dividends. It's on the books as a debit. Let's go ahead and credit it then, opposite thing, to remove it. Then we're going to go down, and we typically do something to the income from S account. So I'm going to say, all right, income from S. We got to remove, the portion of the controlling interest portion of net income, this 32,180 standard procedure. So we're going to take that times the controlling interest, which is 90%. And then we're going to take the non-controlling interest and apply out the 10%. Standard procedure. So we're going to take the 32,180 times the 10% times the 10% non-controlling interest. Okay, so now we're going to take the assets minus liabilities, or the 119,180, also equal to equity, the 119,180, also equal to what we've done thus far, 119,180. We're going to allocate that out, controlling, non-controlling interest going to the investment in S, non-controlling interest going to the non-controlling interest in A net assets. So let's do this one first. It's going to be a credit here, negative sum. Let's pick up the assets minus the liabilities. We can pick that up and say, all right, times, I'll take the 10%, the non-controlling interest. And up here, same thing, negative sum of these items. We're going to go ahead and close that up and multiply that times the controlling interest, or 90%. And then, is this thing in balance? Does it add up to 0? It does indeed, so that makes us feel good, secure, happy. So we're going to go ahead and then it won't last. No. So then we're going to go over here and post it. 107,262. We'll take that down, so nothing tricky happening. That does what we would expect. That's nice. Then we're going to go to the common stock and say this one should be then removing the S portion, bringing us back to basically P's numbers. Let's go to the retained earnings. Same thing on the retained earnings. Same process should be taking place as it does, as suspected. The thing we thought was happening happened. So then we got the 29 and the 29. And then we've got the income from S down below. We'll pick that up, and that's going to bring it down to 0. So that's nice. Nothing funny's happening here. Those are down to 0. Then we've got the non-controlling interest. Going to pick that up in the net income and the non-controlling interest in the NA. So all that works just as we would expect, and just excellent. So now we're going to be removing the bond, all the bond stuff, the new stuff here. So again, if we have in practice, we would kind of have the trial balance, and of course in the GL, and we can look at it and say, okay, let's remove these intercompany balance sheet accounts and then the intercompany income statement accounts we just figured out here. So this bonds payable, which is now on S's side of things, that needs to be removed clearly. So that's a credit. So we're going to debit it. The premium's on the books at a credit, so we need to debit it. And now if you're in a book problem and they just kind of ask you this without showing you any numbers, then you got to know that, a premium's a credit and, a discount's going to be a debit, right? But obviously in practice, we typically will see that there. We say, yeah, well, let's got to do the opposite thing to get rid of it. And then we're going to have the investment. So the investment in S bonds is here. We know that's got to leave because that's like intercompany stuff. And so that adds up to that's like the balance sheet side. So let's record that first. So let's record that first. We've got the bonds payable. Let's remove that. So bonds payable. That doesn't bring the bonds down to 0 because there's more bonds apparently, but hopefully they're not intercompany. That brings us down to what was on P's books, which wasn't an intercompany bond apparently. And then we've got the bond premium, which we're going to remove. Got to get that off the books. If the bonds are gone, the premium's got to be gone. It's only makes sense. Then we have the investment in S bonds up top. That too needs to be removed and bringing it back down to 0. Then we'll do the income statement side of things, which of course is the income and the expenses should net each other out there. Might not be so obvious in practice to see those because there might be other things involved, but we should be able to kind of dig those out and say the interest that was paid. If you look at the GL, the interest that was paid to S, the interest that was received, or the interest that was paid by S2P, and so on and so forth. We should be able to see that in the GL here. So this is income. It needs to go down. So we're going to do the opposite thing to it, and that's going to be debiting it. And we're going to credit the expense. And there it is. So negative of that number, and then there it is. So we'll reverse that one out. So here's the interest income. We've got the interest income. Let's remove that. That needs to be removed. And then we're going to remove the other side on the expense side of things. Removing the expense side of things. And there we go with the intercompany bonds. We can see these two are down to 0 as expected. And then we can kind of check out, of course, the equity section being the ending equity basically tying out to P's equity. And then we can check out those bonds accounts to make sure that both the balance sheet side have been removed, as well as the income statement side, including interest income and interest expense.